These are the taxes that catch California seniors off guard after retirement, not because they are secret, but because their real impact does not fully appear until regular paychecks stop. This video explains how retiring in California exposes seniors to income taxes, sales taxes, property-related charges, and policy changes that feel manageable while working and far more demanding once retirement actually begins. For many Californians, the financial system feels predictable during their working years. Income arrives on a steady schedule, taxes are withheld automatically, and increases in costs can often be absorbed by earning more or working longer. Retirement changes that balance in a fundamental way. Income becomes fixed or semi-fixed, expenses become harder to adjust, and taxes that once felt tolerable begin taking a larger share of every dollar that comes in. The shift is subtle at first. Nothing dramatic happens on the day someone retires. Bills arrive as they always have. Purchases continue. The difference shows up gradually, as retirees realize that money does not stretch the way it used to. The frustration comes from not being able to point to a single cause. There is no obvious tax hike to blame, no single policy that explains the squeeze. Understanding why retirement feels different in California requires looking at how several parts of the tax system interact once earned income disappears. Each part on its own seems reasonable. Together, they create a situation that many seniors never anticipated when they planned their retirement. One of the earliest surprises comes from California's treatment of retirement income. California does not tax Social Security benefits at the state level, which creates a strong impression that the state is friendly to retirees. That impression fades quickly once other income sources begin arriving. Private pensions, public pensions such as CalPERS and CalSTRS, 401k withdrawals, IRA distributions, and annuity income are all treated as ordinary income for California state tax purposes. For retirees who spent decades contributing to retirement accounts under the assumption that taxes would be lower later in life, this feels like a reversal. Income that was deferred during working years becomes fully taxable once withdrawn. The shock is not just the tax itself, but the realization that retirement does not automatically mean a lower state tax bill. What makes this more confusing is the way retirement income arrives from multiple directions. A pension payment may come monthly, investment income may appear quarterly, and withdrawals from retirement accounts may happen once or twice a year. Each stream feels manageable on its own. When tax time arrives, they are combined into a single total. That total can land retirees in brackets they did not expect to see again. California's income tax system is progressive, with rates that rise as income increases. As of the 2024 and 2025 tax years, the top marginal rate reaches 12.3%, with an additional 1% surcharge on very high incomes. While most retirees never approach the top bracket, the structure still matters because even moderate increases in income can raise the overall tax burden. Required minimum distributions often act as the trigger. Federal rules require retirees to withdraw a certain amount from tax-deferred accounts once they reach the required age. These withdrawals are mandatory, whether the money is needed or not. In California, every dollar withdrawn counts as taxable income. This creates a situation where income rises on paper without improving lifestyle. A retiree may be forced to withdraw funds they do not plan to spend, yet still owe state income tax on the withdrawal. Some reinvest the money. Some move it to savings. None of that changes the tax treatment. The frustration grows when retirees realize that these withdrawals can push them into higher brackets. A modest increase in taxable income can raise the effective rate applied to all income. The result is that a required withdrawal designed to spread retirement savings over time ends up accelerating tax exposure instead. This effect compounds when combined with cost of living adjustments on pensions or investment income. Small increases that are meant to keep up with rising prices can instead trigger higher taxes. Although California adjusts its tax brackets for inflation, those adjustments do not always align with the real expenses retirees face, especially in housing, healthcare, and insurance. The result is a form of quiet bracket creep. Income increases slightly, taxes claim a larger share, and purchasing power remains flat or declines. There is no announcement explaining why this happens. It simply shows up as less flexibility in the monthly budget. Sales taxes add another layer of surprise. California's statewide base sales tax rate stands at 7.25%, the highest in the country, according to the California Department of Tax and Fee Administration. That rate alone places California at the top nationally. For retirees, the base rate is only the beginning. Cities and counties are allowed to add their own district taxes, and over the years many have done so. These additions are often approved through local ballot measures framed around specific goals such as healthcare funding, transportation projects, public safety, or community services. Each measure seems narrow. Together, they raise the cost of nearly everything retirees buy. By 2024 and 2025, combined sales tax rates between 9.5% and 10.25% had become common across large portions of the state. In Los Angeles County and many Bay Area cities, paying a 10% sales tax is now routine. These rates did not appear overnight. They grew incrementally, one local vote at a time. Sales taxes affect retirees differently than working households. The rate applies regardless of income. Someone earning six figures pays the same percentage as someone living on a modest pension. Retirees also tend to spend a higher share of their income on routine purchases, which magnifies the effect. While unprepared food is generally exempt, many unavoidable expenses are not. Clothing, household items, appliances, auto repairs, home maintenance, and personal services all reflect the full local sales tax rate. Each purchase carries a slightly higher cost than it did before. The impact does not come from one large expense. It comes from repetition. Over weeks and months, those extra percentages add up. By the end of the year, a noticeable portion of retirement income has been redirected to taxes without any clear point where the change began. Property taxes introduce another set of misunderstandings. Proposition 13, passed in 1978, capped the base property tax rate at 1% of assessed value and limited annual assessment increases. For decades, this rule has been presented as a safeguard for homeowners, and many seniors rely on it when planning retirement. What often gets overlooked is what Proposition 13 does not cover. Voter-approved bonds, parcel taxes, Mello-Roos assessments, and special district levies all fall outside its limits. These charges accumulate over time as communities approve new measures. As a result, many homeowners now face effective property tax rates closer to 1.2 or even 1.4% once all add-ons are included. For retirees who planned around the 1% figure, this difference matters. Housing costs rise even when assessed values increase slowly. These charges are often described using language that downplays their impact. Terms like assessment, fee, or levy can make them sound temporary or minor. In practice, they function exactly like taxes. They appear on property tax bills, and they must be paid to remain in the home. Proposition 19 reshaped expectations again starting February 16, 2021. The measure changed how property tax bases transfer between generations and altered long-standing rules around inherited property. While some benefits for seniors who move within California remained, the overall structure became more restrictive. One of the most consequential changes affected inherited homes. Under the new rules, children must live in an inherited property as their primary residence to keep the existing tax base. If they do not, the property is reassessed at current market value. That reassessment can dramatically increase property taxes. For retirees, this change affects estate planning and housing decisions. Plans made under the old rules no longer work the same way. Downsizing, relocating, or passing property to children can now trigger tax consequences that were previously avoidable. Many retirees only discover these changes after retirement, when plans are already underway. The realization that a family home may carry much higher taxes for the next generation can force difficult decisions late in life. Local tax measures deepen the sense of unpredictability. Counties and cities increasingly rely on sales taxes, parcel taxes, and special assessments to fund services. Santa Clara County, for example, approved a sales tax increase tied to hospital funding during the 2024 to 2025 period. Similar measures continue appearing across the state. From a retiree's perspective, these increases feel constant. Each one is small enough to pass quietly, yet together they steadily raise the cost of living. Unlike working households, retirees cannot offset these increases by earning more. Adjustments come instead through reduced spending or lifestyle changes. Relief programs exist, but they remain limited. The Property Tax Postponement Program allows eligible seniors aged 62 and older to defer property taxes, turning them into a lien on the home. This can help with short-term cash flow, especially during tight years. The limitations are significant. Income thresholds apply. Home equity requirements apply. Participation rates remain low relative to eligibility. For most retirees, postponement delays the burden rather than eliminating it, which explains why it rarely feels like a solution. These combined pressures help explain broader migration trends. Since 2020, California has experienced net domestic outmigration according to U.S. Census Bureau and IRS migration data. Retirees make up a meaningful share of those leaving, and taxes frequently appear among the factors influencing that decision. Supporters of California's tax system argue that seniors still receive important protections. Proposition 13 limits assessment growth. Social Security benefits are not taxed at the state level. Tax revenue funds healthcare, infrastructure, and public services that seniors rely on. These arguments remain central to policy debates. Critics focus on outcomes rather than intentions. Fixed-income retirees absorb rising costs without flexibility. Local taxes fragment responsibility and obscure the true burden. Retirement income taxation reduces the appeal of aging in place. Over time, the system shifts more pressure onto seniors after retirement begins. As of 2025, no comprehensive statewide reform directly addresses the combined tax impact facing retirees. California continues to rely on local measures and incremental changes. For seniors, this means the surprises often appear only after retirement is underway. Retiring in California rarely becomes difficult because of one dramatic tax increase. The challenge comes from how many small taxes accumulate once income stops growing. Understanding that pattern does not remove the burden, but it explains why so many seniors feel caught off guard after decades of careful planning. This is the reality behind retiring in California and the taxes that surprise seniors. Not one policy decision, but a system that feels manageable during working years and far more demanding once retirement actually begins.